Legal disclaimer. Before we begin, this video is for educational purposes only. It is not financial advice. Always do your own research and consider speaking with a qualified professional about your personal situation. How to start investing in Canada, beginner's step-by-step guide. If investing feels confusing, overwhelming, or risky, this video will simplify it. By the end, you'll have a clear step-by-step plan to start investing in Canada. Calmly, confidently, and without guessing. Acknowledge beginner confusion. If you're new to investing, you might feel lost. There are so many accounts, so many apps, so many opinions online. Some people talk about trading, others talk about crypto. Some promise quick profits. It's easy to feel like you're already behind. But here's the truth. You don't need complicated strategies. You don't need to pick winning stocks. And you don't need a large amount of money. You need a simple structure. Let's build that now. Step 1. Understand what investing really is. Investing is not gambling. It's not trying to get rich next month. Investing is simply putting your money into assets that grow over time. When you invest, you're buying pieces of businesses, or lending money through bonds, or owning diversified funds that hold many companies. Over time, as the economy grows, your money grows with it. That's it. Long-term, patient, consistent. Step 2. Build a financial base first. Before you invest, make sure a few basics are covered. Have some emergency savings. Pay down very high interest debt, like credit cards. Make sure your bills are stable. Investing works best when you're not forced to withdraw money during emergencies. Think of investing as planting seeds. You don't want to dig them up every time something unexpected happens. Step 3. Choose the right account. In Canada, you don't just invest. You invest inside an account. One of the most common starting points is the tax-free savings account, or TFSA. Despite the name, it's not just for savings. Inside a TFSA, your investments can grow tax-free. Capital gains are not taxed. Investment income is not taxed. For many beginners, this makes it a simple and powerful place to start. Other accounts exist, like the Registered Retirement Savings Plan, or RRSP. An RRSP gives you a tax deduction today, but withdrawals are taxed later. For beginners with moderate income, the TFSA is often the easiest first step because it's flexible and simple, but always consider your personal tax situation. Step 4. Open a brokerage account. To invest inside a TFSA or RRSP, you need a brokerage. Many Canadian banks offer investing platforms. There are also independent online brokerages. Choose one that is easy to use, low cost, simple interface. You do not need advanced trading tools. Remember, you're investing long-term, not trading daily. Step 5. Why ETFs are simpler than picking stocks. Now we come to one of the biggest beginner questions. Should I pick individual stocks? You can, but it adds complexity and risk. When you buy one stock, you're betting on one company. If that company struggles, your investment suffers. Instead, many beginners choose ETFs. ETF stands for Exchange Traded Fund. An ETF is a single investment that holds many companies. For example, one broad market ETF might hold hundreds or even thousands of companies. Instead of guessing which company will win, you own the entire market. This reduces risk, it saves time, and it removes emotion. For long-term investors, simplicity often wins. Step 6. Growth versus income. When investing, you'll often hear two goals: growth and income. Growth investing focuses on increasing the value of your portfolio over time. Income investing focuses on generating regular cash flow, such as dividends. For beginners who are still working and building wealth, growth is often the priority. You reinvest earnings. You let compounding work. Income strategies can make sense later, especially when you want passive cash flow. There is no single right answer. But early on, growth and diversification are usually simpler. Step 7. Start small and invest consistently. You do not need thousands of dollars to start. You can begin with small amounts. What matters more than the size of your first investment is consistency. Investing $200 every month for years is more powerful than investing $5,000 once and stopping. Consistency builds discipline. Discipline builds wealth. Automating your contributions can help. When investing becomes routine, emotions matter less. Step 8. Common beginner mistakes to avoid. Let's quickly go over what not to do. Don't try to time the market. No one consistently knows when it will go up or down. Don't panic when markets drop. Volatility is normal. Don't chase trends. If everyone is suddenly talking about one investment, you're likely late. Don't overcomplicate your portfolio. Owning one or two broad ETFs is often enough to start. And most importantly, don't wait forever. Learning is important. But action matters too. Step 9. A simple beginner framework. Let's simplify everything into clear steps. Step 1. Build an emergency fund. Step 2. Open a TFSA. Step 3. Choose a low-cost brokerage. Step 4. Buy a broad market ETF. Step 5. Invest consistently every month. Step 6. Stay patient. That's the foundation. It's not flashy, but it works. Don't worry. If you feel overwhelmed, that's normal. Every experienced investor once started exactly where you are. Confused, unsure, cautious. You don't need to be perfect. You just need to begin. Investing in Canada can be simple when you focus on long-term growth, low costs, and consistency. Over time, those small steps can become something meaningful. If this helped clarify things for you, let me know in the comments what stage you're at. Are you just starting, or have you already opened your first TFSA? And if you'd like more calm, beginner-friendly investing guides for Canadians, subscribe and follow along. Slow, steady,